Hi and welcome to Swissquote's Daily Market Talk. So it's August 18th. Last Friday's meeting between Donald Trump and Vladimir Putin has ended on a positive note, meaning no additional sanctions for Russia, nor for countries that actually buy oil from them, and also opened the way for a second meeting between Donald Trump and Volodymyr Zelensky this time and the European allies that is due later today. So equity markets around the globe are hopeful and oil is trending lower this morning on this hope for a sustainable truce in Ukraine. So we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice. So Friday's meeting between Trump and Putin seems to have gone quite smoothly. We don't have a bunch of details about what has been talked about, but we know that the meeting led to no further tensions between the US and Russia or to no further sanctions for nations like China and India that actually buy oil from Russia. So US crude actually gapped lower at the start of this week, but has recovered a part of losses so far. The direction remains pretty unclear at the time I'm talking here, despite the lack of an initial stress. Trump will meet Zelensky and the European leaders later today to deliver an important message from Kremlin about what Russia actually wants to end the war in Ukraine. Now, we know that Russia wants territory. We also know that Ukraine doesn't want to cede territory to Russia and is asking security guarantees from its Western allies. So even though there is actual hope that the parties could eventually make material progress toward ending the war in Ukraine, which would then further give support to the oil bears in the market and pressure oil prices further down and eventually below the $60 per barrel psychological level, while risk of a disappointment today remains well on the table. So next hours will give fresh direction to oil prices from a macro perspective. Just remember that the ample OPEC supply and also the cloudy global demand, mostly due to the trade disruptions between the US and elsewhere, and the subdued demand from China actually keep oil prices under pressure and within the medium-term bearish trend. The IEA last week forecasted that the global oil markets will be printing their largest surplus ever as a result of piling inventories, which is at the rate of almost 3 million barrels per day, the IEA said, higher than the pandemic days. So the bulls actually argue that the US production will top near its all-time high levels sometime in the coming months and years and ease from there, while the softer US dollar helps boost oil demand from emerging markets. But will that be enough to keep oil prices in check? Well, we will see. In summary, the bearish camp weighs heavier so far this year, while geopolitical risk lead to temporary price spikes. Now, zooming out, Asian markets kicked off the week on a relatively positive note this morning. Chinese equities rallied 1.5%. The Indian Nifty 50 jumped 1.4% as well, disrupting a steady decline that has started since end of June on 10 straight talks between the US and India. In fact, a truce between the West and Russia would be incredibly welcome for the two nations, India and China, that did never want to pick a side in the Russian West tensions in Ukraine due to their valuable relations with both sides. So European and US futures are ended positive at the time I'm talking here as well. The Japanese yen is softer against the US dollar, but we actually see some strong appetite for gold still, and that is hinting that investors are still not fully confident about the outcome of Trump and Zelensky meeting that is due later today. Now, any material progress in that meeting and toward truce in Ukraine could lead to further sell-off in oil prices, a rally across global equity indices, and softer appetite for gold, while on the contrary, any disappointment will likely bring oil bulls back to the market, weigh on equity valuations around the world, except for the defense space in Europe, however, and will likely further boost appetite in gold near the 50-day moving average and just a touch below its all-time high levels. Overall, the markets are now focusing on hope rather than fear this morning. The US dollar is under pressure against most majors, reflecting that optimism about, well, the upcoming meeting between Trump and Zelensky. Fingers are crossed. We all hope for the best outcome from that meeting. Now, last week, European equities extended gains to the highest level since March. So that's before the announcement of tariffs on April 2nd, remember, meaning that the tariff pricing is now fully out. On the earnings front, well, the tariffs mainly hit the European car makers' profits last quarter, with Volkswagen, for example, printing a nearly 30% decline to its operating profit. But the rest of the European industries actually saw limited impact from the tariff uncertainty and the nascent trade war between the US and the European Union. The stronger euro rather help reducing the cost of European companies and has been a tailwind for the European company earnings in the second quarter of this year. It also helped taming inflationary pressures in the Eurozone and helped the European Central Bank to maintain a supportive monetary policy stance. As such, the Stoxx 600 companies actually printed a 3% earnings growth versus a 3% earnings decline as expected, and earnings forecast also improved. So a potential truce between Russia and Ukraine could further back the rally and keep the European markets a sweet option for global investors who are actually looking to decrease their exposure to the US equities these days. In the United States, while the major US indices still consolidate their gains near their all-time high levels on expectation that the Fed will resume its interest rate cuts after a year at the September monetary policy meeting and could even announce a jumbo rate cut under the pressure of the White House. So investors will be very, very curious to see and to hear what the Fed President Jerome Powell thinks about a 50 basis point cut at its next monetary policy meeting, as suggested by the US Treasury Secretary, Mr. Scott Bessent, last week, remember? So this week, the man, Mr. Powell, who actually got caught in the middle of a political turmoil in the United States, will be speaking at the Jackson Hole meeting in Wyoming in the United States. So this is an annual meeting in the United States, as I said, that gathers the world's leading central bankers and finance ministers, and they will be talking about stuff that actually matter to our economies. Now, even though this year's focus will be jobs, investors are craving for any hints regarding the Fed's inclination for the next Fed meeting, along with the Fed minutes that are also due on Wednesday this week. Now, frankly speaking, I guess that we will have more hints about what the Fed could do in a September meeting than Jerome Powell's Jackson Hole speech, because I don't necessarily think that Mr. Powell will be willing to take the risk of making any comments on the Fed's highly politicized next move at the Jackson Hole speech. But we will see what he will say. Now, for those who actually missed last week's inflation data from the United States actually showed no particular pressure or no particular stress on consumer prices, but it actually showed a significant jump on producer prices due to tariffs. So the CPI data first sent the US 2-year yield, which actually captures the Federal Reserve's rate expectations, to the lowest level since May. Then the PPI data came and it led to a rebound in the US 2-year yield. Now note that we are still significantly lower than the levels that we saw before the latest jobs data. So the latter continues to support equity valuations in the US, and any positive news from the Ukrainian front has got the power to send the global equity complex, including the US indices, higher. And if not, well, the dips will be rapidly enough, I think, that you won't even realize that there has been a dip. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.